All right. I gotta double check. Currently we're converting the last Zoom, so it's letting me record and convert at the same time. Oh,
Good
Zoom's great, right? All
deal.
right. So, yeah, what questions do you have? I guess let's start there.
Well, you saw I'm starting to look at. I mean, we talked a little bit about it in the Discord, I think last night on Uncle Tony's trade.
Yeah.
I'm just considering that, looking, trying to look at that versus I've got a campaign going of selling three naked puts on MES. I'm trying to do that every 7 days or so. So one comes off once a week. And
Okay.
that's generating about 75 bucks a week after fees.
Okay.
So it's a nice at your $5.50 where I saw one of those videos. So I go look for the
Yeah.
550 and that's the naked put that I sell and I do three of those.
Yeah.
Um, so I'm weighing that campaign versus looking at doing a 60 DTE on his 1-2 versus
Yeah.
the safeguard trade. So I'm not saying,
Versus or both possibly, because that might
well,
make a difference.
yeah, maybe both. One of my fears, like I really like the safeguard trade, and I'm kind of got that going across three of my accounts. I've got a taxable account, an IRA, and a Roth IRA.
Okay.
And if I look at it right now, I'm due this week to put on another long-term safeguard trade
Okay.
because all of them are sitting. My oldest one is sitting at 95 days. So within 5 days, it'll be down to 90. And now it's time for another 120.
Mhm.
But if I do it, I've got that going on in three accounts.
Uh,
So it's almost like I'm going to put on three safeguard trades and three accounts that are basically all going to end up at the same naked put. And it's going,
mhm.
do I have too much exposure there? Which
Yeah.
then makes me flip and go, I don't have anything hedged other than my put debit spreads on these long-term 112s.
Right. And
So do I need to start?
another factor is the buying power are a little different for the IRA compared to the brokerage.
They sure are. Yep.
So that's definitely something you're going to want to track separately because your buying power is more on the IRAs over the brokerages. So I assume you already did some of those calculations. Where
I watch it, but if I'm only doing the 112 stuff and trying to keep my buying power in both my IRA and my Roth IRA at 50%,
Mhm.
I'm going, then why track it? Because one comes off, one goes on, and I'm using about 50% of my buying power. And I'm going, okay, like why track all that other stuff?
Yeah.
So I know I'm missing something.
If you already did the calculations on how many positions you're able to enter on your IRA compared to the brokerage, then there's not really much you have to worry about. But like what is the buying power in an IRA for the safeguard? It's a little bit more than the brokerage.
It is, but in my IRA account, because of the dollar value, I'm doing one ES every month.
Okay.
And on both my taxable account and my Roth IRA, I'm using MES,
Okay.
but I'm doing two tranches at a time.
Okay. Yeah, perfectly fine doing it your way and just monitoring the buying power. Check once a day, see is your buying power way out of line or if it's pretty close to the 50%. I wouldn't worry too much about it then.
Okay. Because my
As
thought
for
process is even when I get over that, like if I have to, I can always take off the naked puts on my oldest one
yeah,
to free up some buying power,
right.
or at that time go in and buy a put to give me some of my buying power back.
When you do the calculations, are you assuming that the naked puts close out at around 90 or so days, even though it's 120 days, right?
Yes, that's what
Okay.
I'm finding out is that I'm taking those off at
Yeah.
um, around 90 days. Now, the
Right.
interesting thing was when I just started this and just started to learn this process, I had the whole thing going where one was going to come off every month. And then towards the end of 2023, when the market really shot up,
Close them out early, right?
I took off three of them.
Yeah.
Which at the time I'm like, this is fantastic.
Yeah.
But now that I'm sitting here in 2024, the ones that are supposed to come off here in 30 days and then 65 days, there's nothing to take off, and I really got no income coming in because I took
Yeah.
them off.
So yeah, it's a tricky one because we don't know what's going to happen in the future if the market's going future pun intended, right? So the market could shoot up and then you close them out a little bit earlier than normal. The market could stay where it is and you'll be about the 90 days out, or the market could drop and you might be in there 110 days. Might even stop out possibly if it drops a lot. So things that I do for that is when I figure out my allocations, I just assume that it's going to go the full 120 days on all of them, no matter what. It ends up me being a little bit more conservative in my buying power use that way. Like I know that there's a good chance it's going to close out at 90, 95 days in most cases, but I'm assuming it doesn't. And then based on that, I know I have enough funds to follow my plan, assuming they're all going 120 days. So
Gotcha.
it's a little bit safer in that regard, knowing that you have the buying power to take on a trade, even though the one, like the first one you did that's a while ago, is still not quite at your target profit yet. If you're really close to the target profit, knowing it, like you said earlier, there's some that might be a few days from now, it just closes out. You could possibly be okay taking the trade anyway, and just you'll be slightly over in your buying power just for a few days and then closing it. Or you could just play it even safer. And if you're at, say, 85% profit, just close it out anyway instead of the
Right.
90. It's going to be slightly less return in the end, but might have a little bit more peace of mind knowing that you're out of those nakeds and you have more buying power, so you could take the next trade. So it gets a little bit more advanced there and gets a little bit more subtle at times, knowing that. So I would recommend just assuming everything takes 120. It's just easier that way. And
Sure.
then you might have some extra buying power for a couple weeks, maybe at times. It won't usually be dramatic like months. I know it was around October, November last year when the market shot up and I was closing out stuff early. And then I'm like, but what do I do? Well, this excess buying power. I was taking some shorter 112s
Right.
around 60 to 80 or so days. And those were closing out too because the market just kept shooting up. So that's why I had really good returns in November, December. And then I was realizing in my, stuck in the snow in Colorado where I'm like barely alive, there's not really much reason to do all that stuff. Like it's perfectly fine just waiting it out and then just closing at the target profit, re-entering when you have your normal schedule for it. But that's just my personal idea. Like what's interesting about all these things is you could be pretty active on them if you want to, but I don't think there's really much of a need because when you're taking in your trades, you're gonna make, say 3 or so% a month on average. If you follow out the full 120 days. So if you're making about 12% total on the trade when you're entering it, knowing it's 4 months out, just do 12 divided by four. You're at almost 3% a month on average anyway. So there's
Right.
not really a huge rush trying to close them out early. Um, However, if you want to be more active, you could close them out earlier because a lot of time, especially if the market shoots up, you could close your naked puts out at maybe 50, 60%. But if you look at the total return per days in the trade, you might be higher than 3% a month, right?
Right.
So if you're willing to do the little bit extra work, close them out, re-enter a new one a little bit earlier. And I was doing that a few months ago. But that's really a personal preference if you want to actually do that or not. I don't think it's really necessary. Because again, you want to be happy with the return that you're getting when you start the trade and not necessarily hoping it makes a quicker profit per day, closing it
Right.
out
Right.
quicker. And it
Yeah.
also makes it complicated too. Like, what do I do? Because now I have, 20% buying power use and I have all this extra money. But like I was in that case quite a bit in January where I'm just waiting it out. I knew I was going to start my ES safeguard last Friday. So I was at like 30% buying power for a while. You know?
Right. Well, that's why I jumped on that Uncle Tony trade, is because I
Right.
had all this buying power because
Mhm.
I took the naked puts off early, and I'm going, well, I
Right.
don't want to enter another long-term 112 yet,
Right.
because where
And
the
this,
other ones were. And I'm going, here's a 60 DTE trade that I'm going,
right.
okay, instead of a 112, let's look at this and just follow. And I only did one, like,
Right.
so it's 85 bucks on $850 in buying power. So it's more
Right.
of a tool. And you said in the Discord, you should paper trade that first. Well, other than tracking it by hand, I'm not really sure how to paper trade a future.
Okay. Let me share my screen real quick. Um, do you have Thinkorswim by any chance?
I do.
So if you have Thinkorswim, I'll open it up and you can just do it on paper there. If you're approved for futures on Thinkorswim, you can do paper trade futures.
Gotcha.
So that's
Okay,
how I would do it, just so you can see
gotcha.
what the actual returns happen. I like the analyze tab more on Thinkorswim anyway,
You
because
do?
yeah, a little bit more. It's more robust. You could do more things on your VIX changing and percentage chance that it might touch certain prices and whatnot. But yeah, not absolutely necessary. Just a personal preference there. That's one way to go. Again, it's not the end of the world. You took the trade. It's about $800 in buying power. It's not a
Right.
ton compared to your account, so it's not going to be the end of the world. If you knew what your stop loss is anyway, and then you happen to stop out if the market drops a lot quickly, then sure. But otherwise, I think it should be okay. Let's just wait for Thinkorswim, and 10 minutes from now, it'll finish installing the
Right.
updates because every single time you do this, it takes forever to install the
That's
updates.
usually the way it works.
Unbelievable.
I
I
know.
remember talking to the help desk, and they said you should actually restart the program about every week or so because they do so many updates all the time. It actually helps like refresh the data apparently.
Gotcha.
So FYI on that one. But I barely use Thinkorswim on my computer anyway because I'm always at work teaching and I don't have
Right.
access to this and I do it on my phone. But the Analyze tab's a lot better on desktop compared to phone. All right, so let's try to mimic a similar trade to that one too. Um, so let me ask. It is just a ratio spread in the end, so you're gonna be buying one and selling two, right? I think I
Yep.
wrote down the approximate deltas. Let me check on my Google Keep.
Yeah,
Real-
he 25 is what he
I
buys.
already have it. Let me see what I wrote in the notes so you can see it on the screen here. I have a separate little label here for my futures on
Nice.
Google Keep, and there's a bunch of stuff here. Did I put Uncle Tony? I think I did. Oh, there you go. This is what I wrote in the notes based on his video. It might be similar.
Yeah.
Some of these were older videos he did, like how he does
Uh-huh.
his 111, 221. I don't know if I wrote it. Oh, it's
I,
around there, I think, right?
I don't really see it. Yeah. So whatever he buys, the whatever it costs him to buy that 25 Delta put, he adds 20 to the cost and then divides that by two, and that determines what he sells his two puts for.
Was it around 60 days out?
Yep.
All right, so 60 days out. It was around 4690, 4700 or so. Do you remember what you sold yours at?
I bought the 4650 and sold the 4575 when I did it.
4650. And now 4575 is a 0.16 delta. Looks like it's really close to the expected move, which is
Yep.
interesting. Let's see. So 4812 is the current price. Expected moves around 225. 4587, really close to expected move. It might have been exactly at it when you did the trade, right?
It was one strike outside the expected move.
All right. So we're going to be buying the 4650, selling two of the 4575s, right?
Correct.
Do you remember what your credit was for
Yeah,
the
I'm
trade?
gonna look when it was all said and done.
Yeah. I think you said you made about $80 or so, right? Or 85.
Yes. Yep. Uh,
So it's pretty close to what it is now. 16 times 5. Probably around 16, 17.
yeah. Yeah, I'm looking while you're doing that. I think we're right in that ballpark. Trade history. 1850 is what I
Oh, that's
got.
good. Yeah, a bit higher. All right, so I've just entered it in here. Right click, analyze trade, and then you're gonna see the nice triangle pop up. No, I got other trades on. Let me get rid of that. So
Yep.
annoying when you gotta close out everything and re-enter it.
Yeah, I've never figured out a good way to do that.
I just clicked on all, uncheck it. So
Okay.
now there's nothing on there. And you can actually delete I have a lot on here. Delete all these. But
Okay.
ah, I think I just took it a trade by mistake. Luckily it's paper. All right. Right click, Analyze trade, and we get this nice triangle. Okay.
Yeah.
So let me just go over it. This is a ratio spread where you sold one put, sorry, you bought one put at a pretty high delta. You sold two puts at around expected move. Right here is pretty much where you sold your puts at. What was it, 46.75, I think?
45.75.
45.75. Okay. So 45.75. What's interesting about this trade is you're at the 10, sorry, the what is it? Trap tents, whatever. You're at the minimal profit at 46.50 or so. Then it gets a higher profit. Your break even is around 44.82 or so. I think I did the same premiums, 18.50. Yeah.
Yep.
So it should be the same. And my percentage things are messed up on these. I'll have to fix that later. So what's interesting is you sold two 45.75s, but your break even is all the way down to 44.82. And the reason for that is the bought put can make quite a bit of extra value if it drops a bit, and your bought put's a bit higher than where your sold puts are. So now
Right.
the tricky part is, where are we going to close this thing? You're almost never going to hit exactly at the peak of the triangle here. There's a chance you get somewhere in this range where you could have a slightly extra profit. There's the biggest chance it's going to be at this profit, which is about what you took in, right? About $90 or so.
Correct. Yep.
So you want to look at this purple line and see how it changes over time. The purple line will be, sorry, it's this one. The purple line will get close to the green line as you get to expiration. So you can see how it's moving towards it. And this is about a month and a week. This is about 2 months is the end. A few ideas, just, eyeballing it. I haven't done a lot of research on this.
Here's
Around here, beginning of March or so, you have a really good profit zone. You could go down to around 45.62, which is a little bit below your sold and still a break even. And then you could be at a decent profit above it. So what are your thoughts on it?
So here's a couple interesting things he said in the video that intrigued me. Is he said a lot of times when he closes this trade out, he's able to close the trade at a credit. So he said
Yeah.
he gets paid to get into the trade and he gets paid to get out of the trade. And the other thing that he said that intrigued me is, even if this trade gets in trouble, you treat the bought put and one sold
One
put
debit
debit
spread.
spread, and
Right.
then you roll the one naked put down
Yeah.
and out in the future. And
Yes.
that was like, that really intrigued me.
That's an interesting way to go. You could almost treat this like the covered strangle strategy that we do, where we're willing to take assignment and then sell calls. You could also, if you want to be safer, roll those, especially if it
Right.
touches in the money, and then just keep doing that. And it's a good idea. The issue is the buying power use could be really tricky to calculate, especially if you're rolling it. So when I do
Yeah.
the covered strangle strategy, we're selling two puts. One is around the expected move or a little bit higher. The other one is around 0.1 delta or so. If you want to get assigned on an MES contract, it's about $1,500, give or take. So if you times that by two for two contracts, you're looking at $3,000. And that's the amount I use when I set up the covered strangle. It's a little bit conservative. We almost never use the full 3,000 for buying power plus cash on the side, but I'd rather be conservative than be aggressive in the buying power because you could get in trouble there. If you touch in the money on the sold put, you're pretty much at near the $1,500 anyway. So just be aware of these numbers when you're possibly rolling it. That's probably the best bet I would say, is treat
Right.
individual trade as a certain amount of buying power. I would consider close to the $3,000 on this one. It's going to be less in almost every case, especially since that bought put is at a high delta, and there's a good chance that that could be some profit. But if you want to make it safe, I would go around 3,000, maybe a little less, 25, 2,800 or so for this particular trade. And then you want to be tracking all the trades that you're doing and the approximate buying power plus cash it takes in. That's the way that I do it, which is a little, it's not going to be 100% accurate anyway you do these things, but that's the way I do it because then I know if a certain trade is a little bit against me and challenged, I know I have the buying power for that particular trade. That makes sense or not.
Makes perfect sense. And I'm intrigued because, even if this gets in trouble, I basically have one naked put to manage. That's it.
Right.
That's
Yeah,
the
because
only
the
thing
put
that I
debit
have
spread
to worry
profit.
about.
At what
Yeah,
point do you think you would take profit on the put debit spread where you buy one put and sold one of those puts and get out of those?
that's a great question, huh?
It's hard to know
I don't
because if
know
you look
yet.
at this, if you look at this purple line, so at this point, like around here, like beginning of March, you're not going to be able to close it for a credit higher than what you started with because you see the purple line pretty much lines up with the green line here. And this purple line is not above it anywhere yet. So you're going to have to wait about a month and a half or so before you might get to the situation like around here where you see the purple line is above this green line right here. Does that make sense?
Yep.
So the point there, if you're getting close to challenged, let's say it's around mid-March, well, end of March will be over. You'll have to go near second week of March or so, where you're a little bit higher in the hump here. It's around 4660, 4600 even. Like, yeah, like around here, you're a little higher than the initial credit, which is fine. And then you could get out of the whole trade at that point, or you could just get out of the put debit spread and then keep the naked rolling and all that. It's very flexible. It's a good
Yeah.
trade. Um, I would probably come up with a certain target percent on the put debit spread part. So the way to do that, and again, I'm just kind of brainstorming right now. I haven't done a lot of research. It's just like my head is just waking up after all the caffeine. You bought a 4650 at 35 or so.
40.
Oh, 40. Okay. What did you sell the 4575? What did you sell one of them
29,
at?
29.25.
So
I
the
sold two.
debit, so subtract those, you'd get your cost. What is that about? Eight, nine? I'm not sure the exact numbers. What was the numbers again? I'll put it in.
So my cost on is 1075.
1075. So times five costs you about $54 or so. Um, you could make a certain target profit if you double that or so. I mean, that's a little bit conservative. So if this makes $100, you could close. You just do a separate order to close. The bought put and one of the sold. If you want to be a little more aggressive, you go for around $150 or so. The max profit on the put debit spread is 4650 minus 4575, 75 with times five. So you can make up to 375 on the put debit spread. If it closed below 4575 at expiration, it'll be this minus the debit. So 300 something dollars. However, at that point, you'll be rolling the other naked, right?
Right. Yep.
So, yeah, the slightly aggressive way would be to do it that way. What I would personally do is if it touched 45.75 somewhere in early March or so, and you still have at least a week before expiration, I would probably just close out the put debit spread at a good profit and then roll if it touched in the money on the naked. That's how I would do it. So if it touched 45.75, at that point, I would roll it down and out. Now, as for where to roll it down and out, a lot of options.
Sure.
You could roll it at the exact same strike, get a lot of premium that way, roll it a month out or so. You can roll safer, we roll it down and out for very slight credit or no net credit at all. I know Uncle Tony says, I always want credits every time, which is fine. You can do it that way. But the thing is, you're getting a lot of credit on the put debit spread anyway when you close it out. So you can factor that in.
Right.
It's up to you. What are your thoughts?
Um, I would, if I was gonna roll it, I would roll it out and I would look at how much credit could I get for what I had to buy the 45.75 back? And how much
Okay,
further away could I get in the strike price for doing it at zero?
at
And then
zero. That's how I would
I would
answer.
weigh to go, can I put some money in my pocket if I get a little bit closer? Um,
Right.
that's what I would look at.
Now, it
But I'm
depends on when it touches in the money, of course. If it touches
right.
in the money right away, you're going to be at a decent loss in the whole position.
Right.
because the pink line, let's say it's mid-February and it touches it already, you're gonna be at a loss around here anyway. It's a tricky one. And the put debit spread won't make the full profit until expiration, even though
Right.
you could be pretty far, past the sold put anyway. You're gonna have to wait until the time in the theta decays to get to near expiration anyway. So I would say if the market drops right away, you would have a set stop loss at a certain percent of what you took in. And that's a safer way to go. You can
Right.
maybe make it 3x. So you took in around $85, $90 or so, right?
Yep.
Um, 1850 times 5. If the whole position was this times 3, on 277, I'd probably close out the whole thing because if it happens pretty quickly. So if this happens in the next like 3, 4 weeks, then I probably would just stop out. Because if the market drops a lot, sure, your put debit spread can make some decent profit, but your two sold puts are pretty rough on your buying power if it drops right away.
Yep.
If it's near early March or so and you only have a few weeks left, you could consider rolling it when it touches in the money, or you could roll it the day of expiration. Those are the two best times to roll an option because if you roll it when it touches in the money, you could still get a good amount of protection rolling down and out. You don't want to wait too long, and if it's deep in the money, it'll be too late to roll it and get much credit. Or you could, if it's still pretty close to it, wait until the day of expiration, roll one of those short puts, take the profit on the put, the debit spread will be pretty much full profit at that point or really close. And then you've got all the theta decay on the sold puts that you did.
Yep.
Man, this is a Monday and my brain is like pretty decent.
Yeah.
It's like as you do this stuff more and more, you start to realize, like, yeah, I could kind of remember how all these things work.
Yeah. Right. Yep. I
I know
like the
that
flexibility of that trade.
it is,
So,
it's good. Um, what approximate percent of your total account you think you might do that strategy with? No right or
well,
wrong answer to that.
yeah, no, you know what? I don't have an answer. Like right now, if I wouldn't have been taken off those naked puts early on the 1-1 or the safeguard,
Yeah,
I most likely wouldn't even have looked at this.
yeah,
But I've got this buying power, and I'm going, well, I've got a safeguard going on a CL,
yeah.
and I did a sorry for the numbers. I did a 111 on CL. So
Okay,
I'm like, I don't want to put any more money into oil.
yeah,
Uh, but I'm sitting on all this buying power and I'm
right,
going, well, might as well, this looks pretty intriguing. I'm going to try one just to see what happens. So
right.
my mindset is I want to see how much buying power I have left after I get my safeguard strategies all back online.
Yeah. And another thing to consider is as you're making profits on trades, your account will grow. And then at that point, you could have enough, extra $1,000 or so to take that trade and just add that on as like an extra from your profits that you made on previous trades. It's
Right.
another way to
That's a good
consider
idea.
it. Because that's another tricky one is what do you do when your account grows? Like, how do you add in more positions? So
Right.
I'm adding in more safeguard MESs because that's about $1,100 or so. And then eventually your account will ideally grow like really well. And then you could do, like a CL 112, it's like 6, 7 grand, or you could do an ES 112 for 11 grand.
So do you have concerns on the long-term safeguards about having naked puts at the same? I know they're different months, but having naked puts at the same strike prices.
I mean, it could be, you got to consider the notional value if you're selling a lot of them and the market drops immediately. What are some of your hedge thoughts so far? Have you done any hedges
I
besides?
haven't, and that's the thing that's kind of got my little alarm bell ringing a little bit.
All right. Let me go
Going, I
over some
really,
of what I'm thinking on that. We have about 10 minutes left.
that'd be great.
So, a few ways to go, and I'm hearing a lot of rumblings over the weekend from a lot of different people on this stuff. I'm not going to necessarily say one's right or wrong. I'm just going to say what I think. So, the simple way to go, I think this is Raging Bull on Sweet Bobby's Discord. He goes around 14 days out and he does a little bit high, like 1% of his net lick every month. So it's 12% a year, but it's really good protection for black swans. So the way to do that is Just 50 grand account, times it by 0.01, we get $500. He's going to sell one or two, or buy, sorry, one or two 14 days out. So pay about $500. Divide by 50 for ES. To total about 10 premium. That's per month. He's doing every 14 days. So it's about $250 or so that he's willing to spend every 2 weeks with a 50 grand account. I think he has more than that. So you're looking at around 4 or 5 premium total. So you could buy one of those at around 0.05 or so delta, or you could buy two at half that or so. I think that's what he does. You could buy around two at a 0.0203 delta, and that gives a lot of protection because if the market drops and tumbles to like 4,000 or so, these are worth a ton of money, right? That's an easy way to go. If you're willing to see what you're making on your trades, and let's say you're averaging 3% on all your trades, and then figure out a percent that you're willing to spend on that as a hedge. I personally would go up to around 0.5% a month. But if you want to be really safe, go like 1% a month if you want. Okay. What I personally like a little bit more, I'll still do this trade, by the way, if the market is starting to drop a bit. Like if I see the VIX going up really quickly, I'm probably going to end up doing very similar to that anyway. What I personally like to do is go a little bit further out in time and buy a really wide put debit spread. So in this case, I have a good chance of possibly profiting on it. And you could go a little bit higher delta. So again, just rough numbers, 50 grand account. Let's say I'm going to do about 0.5% a month. That's around 1.5% in 3 months. So 0.015. 750. Zero over. So I can spend about 750. Divide by the 50 ES. I could buy and put debit spread for around 15. And then in that case, I could go around 0.0708 delta or so. I could buy around a 1925, sell around a 4 or 5 to make it a put debit spread instead of just buying, the 4250. So I save a little bit because the 3600 does take in a little bit of premium because I'm selling it. It does max out your profits, but you can still make a lot on this. 4250 minus 3600, 650 times 50 or 32 grand is a possible max profit on this anyway. I personally like this way a little bit more because again, you're taking in a little premium on the sold. If the market hits the black swan and it gets to 3,600 anyway, I mean, that's not going to matter too much. You're just going to close the whole thing out anyway, right?
Yep.
And you get a good amount of protection. I want to tend to show the reasons why, but with that really large put debit spread, you're getting a lot of protection based on that bought put, essentially. Um,
So when you
you
do
looked at,
this,
go ahead.
let's say you put that on today, when do you put your next one on?
I usually wait about this is 1.5%. It's a little bit high. I usually would go a little bit less, maybe 1% or so of my net lick. And then I'd wait around 45 days, about half. And then I'll just put another one on at the same 90 or so days. So that means I'm spending 1% of my net lick about every month and a half or so. That's just rough numbers. I'm actually a little bit less than that. So maybe you can buy one for around 0.5% of your net lick and then do that every 45 days or so. If you want to do every 30 days, that's fine too. So you can stack these on a little bit. It's up to you, like what percent of your net lick are you willing to spend on the hedge? So that's a personal question to give. If you're really worried about black swans a lot, it should be a higher percent. If you're not too concerned about it and you have a lot of safeguards in anyway, which have a lot of these mini hedges on with your put debit spreads, you could go a little bit lower. So that's why I lean a little bit lower because of all these put debit spreads we have, especially if you're able to close out the nakeds anyway on the safeguards. You just leave the put debit spreads on. And then another thing that Tom King mentions is closing out the short part of the put debit spread at 90%, which is perfectly fine. You would get away with doing less of these hedges that are just separate from your normal trades that way. However, you're going to be lowering your returns in most cases because you have to buy back those shorts, even though it might be minimal costs, you're still having to pay a cost on it. So Normal
but you're
state,
avoiding having to do this hedge, or you can spend a lot
avoid,
less money on it.
yes, or do a little bit of both. So normal 4,600 buy, 4,550 sell. The 4,550's about 56 or so. You could close that out for around five. That'll be about 90% profit. But that means you're paying five times five multiplier. You're paying $25 out of your total profit if the black swan doesn't work. And at that point, there's a good chance that we're not close to that anyway, because you close out your nakeds. The put debit spread only has a few weeks left in a lot of cases, maybe up to 30 days or so. You could be a few hundred points away in your put debit spread if everything works. Like that happens pretty frequently, not always, but pretty frequently. You would have to be willing to pay the 25, which that's fine if you want to. You already made profit on the naked puts anyway. The way I do them, you're taking in 20 times 2, taking in 40 minus 4. So you're making 36 on the naked puts. And then you're paying for the put debit spread around 8 or so. So you're making anywhere between 25 to 28 in premium if the nakeds are out. Times it by 5, you're at 140. 140 divided by 1100 is a good return. 12% in 4 months, maybe 3 months if you close the nakeds out early. Are you willing to spend $25 on it? Maybe. I mean, it doesn't look bad. So 130, 120. So it'll be 115 over 1100. You're still making 10%. You're in better shape getting rid of the sold put because if the market drops afterwards, that bought put will be worth a lot.
Mhm.
It's a good idea. It's up to you if you want to do it or not. I don't know if it's completely a great hedge for a big black swan. If you do that every time with all your positions and you get lucky and you're able to close a lot of those out, and then the swan happens, it's going to be great, obviously. But it's not going to always happen that way. You're always going to have quite a few where you're still waiting it out.
Sure.
Maybe a mix of both, maybe half the time you close out the sold at 90%, but you still put on a mini hedge on the side at even less percents that I was saying. Buy one at 0.25% of your net lick, something like that. You could easily make it flexible to what you think. So it's a good idea. I might consider doing it. I think I pretty
All
much
right.
I think I pretty much convinced myself there's a good chance I'll do that. Not every time, but sometimes. I don't know. It also helps your buying power because you get rid of your sold put.
No, that's true. Yep.
That makes it a little bit safer in your buying power for your hold position. So
Yep.
yeah, it's a good idea. I'll think about it more. Gotta mull it
Great.
over.
I look forward to hearing what you did.
All right. Yeah, I mean, if you can make 10% in 3 months, I mean, and that's losing all the risk. Like not only you close your nakeds, you close your sold and put debit spread. You have zero risk. The way
Right.
if you leave the put debit spread on, you still really don't have any risk, but you can't make as much if you still have the sold still on. So,
Right.
all
Yep.
right.
All
That was
right.
great talking to you, Todd. That was a
You
lot of
too.
brings. That was a good
All
one.
right.
All
You
right.
too.
All
See you. Bye.
right. See you later.